Thanks, Winnie, and good morning, good afternoon, and good evening, depending where you're calling from. Welcome to the Pilbara Minerals half-year results call. Big warm welcome. And firstly, to start with, I'd just like to acknowledge the traditional custodians of the land on which our businesses operate. In Perth, the Whadjuk Noongar people, and up north, the Nyamal and Kariyara people. We pay our respects to the elders, past, present, and emerging. For introductions today, the speakers we have are Brian Lynn, our Chief Financial Officer, Vince DiCarlos, our Chief Operating Officer, but we also have in the room Greg Jason, our Assistant CFO, Gavin Spores, who's our Acting IR Lead, and we've also got Nicholas Reid and Paul Armstrong from Reid Corporate. Welcome, everyone. Before I get into the formalities of the call, I'd just like to pay acknowledgement to Brian. This is his last sort of public call for us. The last two quarterly calls I'd sort of flagged Brian would be sort of departing. He's been very kindly staying on to support us as we progress the CFO recruitment process. But yeah, this will be Brian's last hurrah essentially for Pilbara. So for Brian, it's been a hell of a journey from the tin shed and Freo, surviving the downturn, and then here we are today with our inaugural dividend. A hell of a journey for business and for the CFO who stewarded that. And Brian's contribution has been immense. Brian has been the chief architect for all of these key growth steps that we've gone through today. He's driven, he's hyper conscientious, and he's an absolute live wire in terms of humour. He's been good fun to work with. And there's just a little teaspoon of grumpiness that every good CFO has to have. So emphasis on teaspoon. So fantastic contribution, Brian. A big thank you to you. So on behalf of the board, the team at Pilbara, our shareholders, our customers, our many stakeholders, thank you, mate, for the big 6.5 years that you've contributed to this company. You've been a stalwart and a massive key ingredient for everything which has happened. So thanks, mate. Brian has got to write a reply a little bit later. Hopefully, he forgets about the grumpy bit, but we'll see how we go. Now, as to the call outline, what we'll step through is a few summary remarks from myself. I'll then hand to Brian for the half-year financial results. We'll then go to Vince, who's going to talk a little bit about the guidance for the financial year, and then back to myself to talk about strategy, growth, and a few final comments around the market and our views of what the outlook looks like. Having gone through that run sheet, we'll then move to Q&A. Given that we've only got an hour today, we'll have approximately 20 minutes for the analysts, 10 minutes for webcast, and then we'll wrap it up on the hour. So referring now to the presentation and stepping to slide 5, it has been an absolute stellar set of results. And it's just remarkable to think that where we are as a business, Pilbara is in the box seat and we are ready to continue to thrive. And it's just remarkable to think we're only just getting started. And here we are with this fantastic set of results, inclusive of our inaugural dividend being an 11-cent interim dividend. So it's just an absolute delight to be, highlighting this milestone and, a key maturity step for the business and obviously a reward going back to many of our loyal shareholders who have gone the full journey of this business. And there was some dark times. So for those long holders of Pilbara, shout out to you and enjoy this first dividend. And delighted that we're able to issue this back out to our shareholders. And as to the numbers, what an incredible set of financial results. The percentages, as you can see, they're enormous, big step ups across revenue, EBITDA, net operating profit, healthy cash balance in excess of 2 billion, net cash, and of course the dividends that I mentioned a moment ago. And before I get step any further into the presentation, I do want to reflect on what we see here today is really the contribution of years of work coming to this point. And there's many teams and people involved in bringing one of these assets and businesses to life, whether it be the Nyamel community, the original customers whom their offtake enabled us to get financing, our financiers, our engineers, our construction partners, our operating partners, the team of Pilbara who have been and have since gone, and of course the team we have today who are working incredibly hard. And frankly, we're still stepping through our own growing pains. And as recent as last week, had some time with the team who took me through some of those growing pains. So a big shout out to those whom have passed, those who are carrying the baton forward. Here we are, a great set of results. So big thank you to the broad team effort which has contributed to this. Now, moving from slide 5 to slide 6, here for those not familiar with Pilbara, we're developing one of the world's best hard rock assets. It's in Western Australia, southeast of Port Hedland, a tier 1 asset offering a 26-year mine life at 1 million tonnes per annum, of which we're only halfway up that expansion profile at a 580,000 tonne per annum run rate. So plenty more growth to come and potentially more growth in the asset itself. We are busy drilling as we speak. So we'll see how we go. But long life asset, great location, and a team which is shooting the lights out in terms of operating performance. Moving to slide 7, a couple of highlights on sustainability. Community investment, we've signed off on a couple of funding pieces recently. The Airbus Foundation, a 5-year agreement there to provide some air screening and medical services to the communities near our operation, being Yandiara, the Strally area, and around South Hedland, and also some funding to the Smith family for some learning scholarships. As it relates to decarbonisation, a 6 megawatt solar farm that's plugged in, turned on, and generating green energy as we speak, displacing 3.8 million litres worth of fuel per year. So great to have that first step of decarbonisation underway. And then as it relates to Indigenous engagement, the most recent update is our cultural nights, camp nights out in the bush with the Nyamel people. There was a female night had. Great to get that underway and a fantastic way for our team to learn more about the Nyamel people and the local area. So thank you to the Nyamel people, and a shout out to Miriam Stanborough, one of our directors who opted in to join that. Moving to slide 8 on safety and people. TRIFR, this bit of a step up on TRIFR, care of reclassification of 2 injuries which occurred in the December quarter. So a bit of an increase there, unfortunately. As it relates to our lead indicators, our safety interactions, they're going well above our target. Our first cultural survey, fantastic participation rate, 87%. So this was our first broad, deep cultural survey. So good to have that done. The team are working through that feedback now, but really important step to understand our strengths, understand our areas of work, and to work ahead to continue to bolster out the great culture, which is the Pilbara Minerals way. And as it relates to female employment, 22%, it's come down slightly. We're about 24%. So more work to be done there, but 22%, more to happen in that regard. So that's a quick snapshot on the highlights. And with this, at this point, I'll now hand over to Brian to step through the financials.
Great, thanks very much, Dale, and good morning, good afternoon, everyone, depending on where you are. Firstly, look, I'd just like to thank Dale for his very kind comments earlier. I would suggest there's been a bit more than a teaspoon of grumpiness on my part, but what I do know is that we've had a lot of fun along the way as well, and that's the part that I'll take away with me. It's been an absolute pleasure serving the PLS shareholders, working alongside a very supportive board, and also with so many fantastic employees and contractors and suppliers at Pilbara Minerals. It's just been an absolute blast. I'm very proud of having been part of a team that has taken the company, as Dale said, from a tin shed in North Fremantle to being part of the ASX 50 today. And I do hope during my 6.5 years with the company, I have contributed in some way to the success of the company. And I feel pretty pleased to be handing over the baton, knowing that the company is certainly in rude financial health. All right, that's just a quick summary from me, and just saying thank you to everyone and saying what an honour it's been to serve at Pilbara Minerals. Moving on to the financial results and referencing slide 10. I have to say that I think I'm very fortunate that my last rodeo for Pilbara is to be presenting a stellar set of half-year financial results that reflect strong profitability, strong cash flow, a strong balance sheet, and importantly, the company's inaugural dividend, with all financial measures significantly higher than the prior corresponding period. In a nutshell, this strong financial result has been driven by three main key metrics. Firstly, we were able to increase the level of spodumene concentrate production. This was driven partly through the Nugajoo plant being ramped up to nameplate capacity, as well as the decision we made to implement a revised production strategy, which is really to target delivering more tonnes at a lower grade into the market. Secondly, we were able to put most of those tonnes on a ship, so we increased the level of shipments to satisfy strong customer demand. And finally, there was a significant increase in the realised selling price received for our product. This really resulted from a strong market conditions and meant that we averaged a selling price of just under $5,000 a dry metric tonne, which is significantly higher than the prior corresponding period. Moving on to slide 11, it's clear that those three metrics that I just discussed really drove some very, very good financial outcomes. Higher sales revenue at $2.18 billion, EBITDA of $1.8 billion, net profit after tax of $1.24 billion, and importantly, cash flow from operations of $1.8 billion. All of that contributed to a cash balance at the end of the period of $2.23 billion, and a net cash position after secured debt of just above $2 billion as well. So certainly a very good set of numbers there. So for the half year, Pilbara Minerals achieved a net profit before tax of $1.77 billion and net profit after tax of $1.24 billion after applying an effective tax rate of 30%. Now, it was all about what we achieved at our operation up in Pilbara, Pilgangoora, which delivered a very healthy gross margin for each tonne of concentrate that we sold of about, in Australian dollar terms, $6,311 per dry metric tonne for the 287,000 tonnes that we shipped. In Aussie dollars, the average realised selling price was just under $7,450, and our unit operating cost, including freight and royalties, was $1,136. So that gives you the margin of $6,300 odd. So if you apply that to the $287,000, 287,000 tonnes shipped, and we also include the margin from the middlings product that we also sold during the period, the operation generated a gross margin of $1.84 billion. And whilst costs were higher during the period, and this was largely driven by higher royalties linked to the selling price, this improved margin was achieved almost entirely on the back of a significant improvement in pricing outcomes. And this was largely due to just a very positive market demand conditions for battery raw materials. Some exceptional results that we were able to achieve for cargoes which we sold on the BMX platform, and also the completion of offtake customer price reviews that we undertook during the period. Moving to slide 13 now. This gross margin obviously translated into a significant improvement in EBITDA. So EBITDA of $1.84 billion, and that flowed into the net profit before tax, and then the headline profit after tax, which, as I mentioned before, was $1.24 billion. So now moving to cash flow and balance sheet. So referencing slide 15 now. This strong EBITDA position also reflected in the cash that the business was able to generate from its operations, with the operation generating $1.8 billion of cash from the operations. We spent about $128 million on capital investments and another $46 odd million on servicing debt and repaying lease liability obligations. And you sum all that through, and we end up with a closing cash balance of $2.23 billion, which is a $1.6 billion improvement from the cash balance at 30 June 2022. In terms of capital investment, the main areas that were invested were obviously the ramp up of the Nuggaju plant, the investment on the P680 project as we move to increase our production profile, capitalised waste, mine development activities. Dale mentioned the installation of the 6 megawatt solar farm, as well as expansions of the tailing management facilities. Now, referencing slide 16, the strong operating performance clearly has added further strength to the company's balance sheet, with a cash balance of $2.2 billion and a net cash position after secured debt of $2.08 billion. So a very, very strong position. Moving to slide 18, and I think this for me is the one. This is really the one that really makes me very happy when I see it. They say that a picture paints 1,000 words, and I think that there's no more obvious example of this when you look at the impact that the company's half-year results has had on the company's cash balance. And it's just important to remind everyone and remind ourselves that over the last 3 or 4 years, when business conditions were very tough, Pilbara took some very deliberate steps to position itself to take advantage of any market uplift when it came. And this certainly has played out in spades during the December half, with a $1.63 billion increase in the cash balance. Finally, I'd just like to talk about the dividend, so referencing slide 19. Back in November, we obviously released our capital management framework, and in that we noted that we noted the dividend policy, and we said that would apply for the first time for the 2023 financial year results. Given the stellar half-year performance, the directors have resolved to pay an inaugural interim dividend of 11 cents per share, with a record date of the 3rd of March and a payment date of the 24th of March. This dividend represents a payout ratio of 30% of free cash flow as applied to the half-year results. The dividend will be fully franked, with franking credits starting to be earned when the company commences paying tax from late February, so this month. And once we lodge our 2022 tax return, we will then enter into a monthly instalment system, and through that build up franking credits. And we are very confident that there will be sufficient franking credits to ensure that a fully franked dividend can be paid. So that's everything I wanted to do in terms of highlighting the key parts of the half-year results. And I'd like to now hand over to Vince, our Chief Operating Officer, to cover off on our updated guidance, which we released along with the half-year results. So over to you, Vince.
Thank you, Brian. Starting on slide 20, starting with the production guidance, we previously guided to 540 to 580 kilotons of spodumene, and we are now guiding to 600 to 620. This is on the back of a couple of primary factors. Firstly, continued consistent and strong production performance. And secondly, as flagged in previous quarterly updates, we've progressively tweaked down product grade to facilitate higher lithium production yields. As such, for half two, we are targeting a slightly lower product grade to maximise product yield and production given the strong market for lithium.
Moving to unit costs, we previously guided to 635 to 700 Australian dollars per dry metric tonne of con, excluding freight and royalties. And we are now guiding to 580 to 610 per dry metric tonne, where we've tightened the range and lowered our guidance. The previous guidance was high due to headwinds such as COVID, freight, and labour shortages in the resource sector. Some of those headwinds have lessened, such as COVID and elevated freight, and we're observing increased stability. As such, we've improved confidence on our expected cost base. And I would also note the first 6 months of the financial year performed at 595 per dry metric tonne of concentrate sold. So this performance, improved cost-based confidence, and in combination with increased production volumes, has translated into this improved unit cost guidance. Moving on to capital, P680, we recently announced an increase in P680 spend, of which we forecast to spend 195 million for the full year, with the balance to be spent in the following year. Waste mine development, our previous guidance was 130 to 160 million, and we're now guiding to 140 to 160 million, which is largely in line. And given the importance of our mining performance on the overall business performance, we are very much targeting the higher end of this guidance to ensure our strip ratios are healthy, which leads to broader base of ore sources that enables improved mineral feed strategies, which have positive downstream impacts in our processing plants. And with respect to project development and sustaining capital, previously we guided project development to 10.6 million and now guiding to 37.9, and sustaining capex was 32.8 million and we're now guiding to 72. The key drivers here are ramping up investment into our business from an earlier period of underinvestment through tough market conditions. We're now prudently targeting capital through a strong capital approvals process to areas of business improvement such as plant performance and reliability, NPI, technology, and employee hygiene areas strongly linked to our improving culture. We expect to see continued business improvement through these investments. And with that, I'll hand over to Dale.
Thanks, Vince. Now, just moving to a quick recap on our strategy to slide 22. Our aim is to be a leader in the provision of sustainable battery materials products. So the way we think about that is through 4 key legs. First and foremost, it's about delivering on our operating commitments, making sure the operating platform is shooting the lights out quarter on quarter. The second is about expanding that operating platform and making the most of this incredible tier 1 asset that we have, the Pilgangoora asset, where our mine site is. Thirdly, it's about extracting more value through downstream involvement. And then the last plank of our strategy is around diversifying our revenues outside of the Pilgangoora asset base. But importantly, I just want to highlight, we think about these priorities in that order. Operating platform, number 1, expanding the operating platform. 3, downstream involvement. And 4th, the diversification into other areas. Now, just to touch on each of these areas in brief, moving to the operation, slide 24. A fantastic graph here, one for the fridge door. It's almost as nice as Brian's cash balance curve. It's a close second, and looking forward to seeing this continue to incrementally step up in the years ahead as we bring on the next legs of expansion. Speaking of which, moving to slide 26 and talking about our growth. Just wanted to quickly update on the executive team updates here. So the team is growing. We've got a couple of the key execs now signed up. Sandra McInnes, our Chief Sustainability Officer, started this week. John Stanning, our Chief Development Officer, he started last week. And Paul Laybourne, we've got his photo up already. He starts next month. So, yeah, delighted to have these executives join the family. They all come with a fantastic pedigree of experience in their respective domains, and they couldn't wait to join Pilbara. And who could blame them with where this company's at and where we're heading? Now, there's one more to go, which is the new Brian, or the new Abacus, as he was politely termed yesterday. we're still working through that process. We are down to the pointy end, and we've got a couple of fantastic candidates, as you'd expect. So yeah, looking forward to the full set being completed, and this just really speaks to gearing up the business for more growth and to create more value for our shareholders. Now, bringing it to the growth pathway that we have in mind. So, moving to slide 27, just a quick reminder on our staged expansion profile. The P680 project, which bolts on another 100,000 tonnes of production capacity, that's busy being constructed at the moment. It was great to be on site last week to see the civil works essentially complete and materials flowing to site to support that project, and delighted that we've got Primero engaged, our long-term engineering construction partner, busy building that for us. Beyond the P680, the P1000 project, this is going to step us up to 1 million tonnes per annum total production. That project is coming up to FID this quarter. Last quarter, we did approve $38.3 million of pre-FID funding to get the long leads underway to preserve schedule. Team's busy pedaling fast on both those fronts, and yeah, all going well. We look forward to updating on that full FID in the coming weeks. Now, moving beyond our base growth strategy around expanding production and moving to value add, slide 30. So value add, this is all about creating more value through more downstream involvement. And the two pathways principally here are, in the first order, it's about participation in chemicals conversion. Our joint venture with POSCO is underway. They're busy building that plant, and we're looking to be delivering our first product late in the calendar year to support commissioning. And then we've got our midstream joint venture with Calix. What this is about is an R&D project to deliver a different lithium product to market, one in which we think will be superior to the spodumene concentrate we deliver today. Superior in the sense that it's a big uplift in lithium concentration, 6% to 35%. Two, a big reduction in waste. The alumina silicate, which is normally present with spodumene concentrate in the order of 90+%, is removed and left at the mine site. So that's the second benefit. And the third benefit is about a step down in the carbon energy intensity of the product. And we look to achieve that through the application of Calix's vertical electric calciner. We think it's a winner. The test work is great. The scoping study said yes, and we're moving forward with the next levels of study to support a demonstration plant. So we're quietly optimistic around this piece. We'll see how we go. The demo plant's a key piece to demonstrate the validity of what we're exploring here. But look, if that all goes well, this could be a game changer for our business and for the industry, but we'll see how we go. But beyond these couple of pieces, we do have more downstream opportunity potential, and that's made possible through this massive production profile that we've got, stepping up to 1 million tonnes per annum. We have quite a chunky proportion of that unallocated. So of course we're turning our mind to what's the best location to commit those tonnes to. So plenty of work happening behind the scenes as we think about that. But in the meantime, we move to slide 31. Just in the last couple of days, we announced a spot sale linked to lithium hydroxide pricing. Now, this is pretty neat, and this piece of work has been in motion for quite some months as we look to explore effectively a tolling construct to effectively parlay our tonnes for more benefit through more economic benefit through tolling. But if I just take a step back, historically, quarter to quarter, we've talked about our unallocated tonnes, and we've talked about preserving flexibility. And the reason we've done that is, A, retain flexibility such that we can choose the smartest pathway to market. Now, those pathways to market, we've always spoken about several, one of which is the BMX platform spot sales. Two, offtake, either short-dated or long-dated offtake, working with our existing customers or new customers. Or three, a tolling construct. Well, the tolling construct, here it is. And this is our first toe in the water exploring this type of construct. And the reason we've elected to do this is we think it gets us further downstream, which supports our strategic initiatives. And secondly, it's a great economic return. So for those reasons, we've elected to have a crack at this, and we'll see how we go. But we like the idea of moving forward with more. Now, that slide 31 offers more detail around the makeup of that construct. It talks to timing, it talks to the volume, and there's a reference to broadly around pricing. But I can assure you it's a great outcome for Pilbara and Pilbara's shareholders. And yeah, as I say, looking forward to exploring this further in the months and years to come. But whilst we're talking about this piece, I do want to address 2 points. One about some of the recent articles, and the second I want to speak to is disclosure. So yeah, we had some articles which really snowballed effectively, reporting on rumours that there'd been a failed auction by a raw materials lithium supplier. Well, as per our announcement, I just want to make it clear unequivocally there was no BMX auction undertaken by Pilbara Minerals in the last few weeks. There was none. So as we've articulated in an announcement, we did do a pre-auction bid, which we've done from time to time, and what that is about testing the market for pricing. And sometimes we've awarded on those pre-auction bids, as we've done historically. If you look back at our 13 or so BMX auctions, sometimes we've elected to do a pre-bid auction. Sometimes we've gone forward with a BMX auction. In this instance, we chose not to do that, and we chose to elect this other opportunity, which we've been having working in the background. So that's the truth. That's how it is. And there's nothing more to be said, really. But I just wanted to make people very clear about what's driving Pilbara Minerals' actions. And as I say, unequivocally, if there's a thought that there was a failed BMX auction for Pilbara Minerals recently, it is simply not the case. The second item relates to disclosure. And yeah, our guiding principle here as a ASX listed company is if we've got a material update, we will update the market. We absolutely will. We have to. And so as we think about future BMX spot sales, will we be disclosing that to market? If we think it's material, yes. So in the current environment, if we were to do a BMX auction, yes, we would disclose it in the current environment because the view we would take is it is material. So I just wanted to make that point clear as well. And as to, before the question comes, what will we do in terms of the next BMX auctions or more tolling? As we've said in these past quarterlies, we will retain flexibility and we will continue to explore each of those pathways to market simultaneously in parallel, and we will select the best option we think for the business. And with all of these are basically bridging steps as we move to more long-dated downstream involvement, because that is the key prize, and that's what our sites are trained on for the long term, a la POSCO joint venture. So moving to the home straight, conscious of time, and just to offer a couple of comments on the market. Moving to slide 33, the sky is not falling in. It looks pretty good to me. There has been some pullback on pricing, particularly within the China domestic market. I would point out that January Spring Festival is always a soft month, and even in the short history of the lithium industry, if you look back at 2018, 2019, 2020, 21, this is the time you see a pullback in domestic pricing as a function of the slowdown in the China market. So we are seeing a bit of that. But what I'd put to everyone is just remind everyone of the structural shift which is underway. You know, what we see is, which everyone sees through the headlines, more EVs, more investment. So that is definitely moving forward. And then the other piece I could offer is, what does Pilbara see as a major lithium materials participant? And it's all positive. So our engagement with customers is all positive. They have They ask for more tonnes. They want more tonnes. Inbound inquiry continues with non-participants, existing participants, etc. So Pilbara enjoys the enviable position of being one of the few major lithium operators who's producing, who's got a readily expandable platform to deliver more tonnes to market, and with no shortage of inquiry of groups wanting to partner with Pilbara. So the long game remains positive, and we've got our sights firmly set on continuing to grow our business in this category. And lastly, to finish, the lithium deficit. So this data is care of Benchmark. This is a refresh of the data they provided us recently. And I'd point out that in 2030, this graph, the last version of this graph, there was no gap. Demand equaled supply, but there's a gap now. And then at 2040, that gap is now widened. And at 2040, that 2.6 million tonne LCE deficit, that's the equivalent of 18 Pilgangoora operations. So don't forget, Pilgangoora, one of the largest hard rock operations globally, and that 18 is sized at the million tonnes per annum. So I'd remind everyone of that, and also remind everyone of how long it takes to bring these assets to life. For Pilbara, it was 4 years from first drill hole to operation, and that is breakneck speed. The world needs heaps of lithium. It's going to take time. The existing operators like Pilbara Minerals are in an incredible position, and pay homage to our founders and the team which followed, who had the conviction and the vision to see the opportunity which is unfolding. And here we are today, Pilbara Minerals, enjoying the benefits of being that first mover, and the dividends we have today really speak to that. So thank you to all those who have come before. So that's a wrap from us. Went slightly longer than I hoped to, and in the closing sort of 25 minutes, keen to take some questions. So at this point, we'll hand back to Winnie to take some questions. Over to you.
Thank you. Wonderful, thank you. If you wish to ask a question, please press star one on your telephone and wait for your name to be announced. If you wish to cancel your request, please press star two. If you're on a speakerphone, please pick up the handset to ask your question. Your first phone question comes from Hugo Nicolaci from Goldman Sachs. Please go ahead.
Oh, hi, Dale and team. Thanks for the update, and congrats on the inaugural dividend. My first question was just more of a clarification on the guidance. You used to disclose capacity, production capacity, that is, on an SC6 basis. Now noting slide 6 footnote that the current capacity is on a 5.7. I just wanted to clarify, firstly, that's driven by Ngungatju performance, and if that's one of the growing pains you mentioned, Dale, and then, noting that grade change, how much of the production guidance increase would you attribute to the lower grade, higher volume strategy? I'll come back with a second.
Sure. Thanks, Hugo. So on the first point, as to product grade, for last quarter we were approximately about a 5.2, and we will look to probably tweak that down slightly. As to the why the product grade is lower, that is in no way related to any sort of production performance issues. We were quite comfortable about both the Pilgan and Ngungatju operations. They're tuned up, they're working well. There'll always be further optimization, but they're controlled, and we're happy with that performance. To the reference around growing pains, that was more actually to do with just some of the support infrastructure we have around mining, nothing relating to the processing plant. We've got some simple enabling infrastructure we need to get in place, which supports the larger fleet that we have. And that's about it. Did that cover your questions there? You go.
Yeah, that's great. Thanks, Dale, for the clarification. The second one, I guess, a two-part on pricing. I mean, firstly, on the toll-linked price, were you given an option to lock in a forward hydroxide price rather than taking that market pricing risk? And if so, how different or how far below versus the current forward pricing would that lock-in pricing have been, if you can give a guide? And then the second part on pricing, obviously recent price movements that you touched on. One of your peers this morning was pointing to regional indices, convergence and geographic exposure, potentially shielding them from the Chinese chemicals price declines. I just wondering if you can give us any commentary around the discussions with offtake partners now looking forward to the next quarter, or I guess more directly, how does the 6,300 price you referenced in December look today? Thanks.
Sure. Okay, there's a bit in that one, Hugo. In terms of the way we've approached this area, we've engaged broadly across the industry to see what the options are in terms of who we want to partner with tolling. So that's been quite a thorough process. And then within that, we of course looked carefully at how we consider pricing. But as per the announcement, you'll see that for this particular construct, pricing is timed all around the shipment and the shipments essentially leaving in terms of spodumene and the arrivals in terms of chemicals. And this is all about us effectively sharing that pricing risk with the converter. So I'd point to that as a bit of a guidance. As to the convergence or the pursuit of various different pricing regimes, the philosophy we've had with our offtake partners is always been about marrying our pricing mechanisms to the products and markets in which they're selling. That's the broad principle, and that would be the broad principle I think we'll look to use as we move forward. Now, the good thing for Pilbara is we have got a broad base of the tier one chemical converters who export internationally. You'll note that pricing is holding up well relative to the domestic pricing at this moment in time. So Pilbara feels pretty well placed for that. And you might also note from our spot tolling sale that pricing is tied to that export pricing as well. Hopefully that helps and fill a bit of detail there, Hugo.
Yep, no, that's great. Thanks, Dale. I'll jump back in the queue. Thanks.
Thank you. Your next question comes from Max Ferguson from Morgans. Please go ahead.
Good morning, Dale. Can I ask a little bit about capital cost inflation? There seems to be pretty different rates of inflation in those different parts of guidance you mentioned earlier. Firstly, what are you seeing in terms of forward-looking inflation? Is it kind of settling down now? And how should we think about the 1 million tonne per annum expansion in terms of, does it kind of sit at the lower end of the capital inflation guideline, or is it maybe potentially towards the higher end?
Yeah, sure. Now, I'll offer a couple of comments and then Brian could probably weigh in on this one as well. So as it relates to capital cost inflation, we're feeling more comfortable that the inflation largely is more under control. We're certainly seeing that at the operating level, which is good. And there's some sub points around, say, for example, freight, which really has come back from the highs to more what we used to have historically, which is good. We have factored in, higher costs as we think about capital, and we have a fairly good feeling around that given our recent market engagement. We're doing long leads, et cetera, et cetera. So that all sort of flows into the estimates we have, which gives us more confidence. But obviously we can't be too sure what happens in the future. Nobody can, but we're feeling that we've got a higher degree of confidence. As it relates to the P1000 capital decision, we'll provide obviously much more insight once we do that FID. So if you could wait for that one, we'll obviously be fulsome in that response there. Brian, anything to add on this?
No, I think you've covered it pretty well there, Dale. Yeah, I've got nothing else to say.
Okay.
Excellent. Thanks, Dale.
Thank you. Your next question comes from Levi Spry from UBS. Please go ahead.
G'day, afternoon, morning. Thanks, Dale and team. So I can just go back to the tolling agreement. I had a few questions around the duration risk. So can you just confirm that it's T+1, i.e. the price is set on the 20th of March? And what index is it referencing? Is it one that we can look at, like fast markets?
So the timelines are fairly they're pretty narrow that we've given on that slide 31. As to the specific reference, no, yeah, we're not going to be disclosing that sort of level of detail on that one. Sorry, Levi, but fast markets is a good one to look at. There's a few others there.
But the price is 1 month. It's 1 month from when it sets sail, from the 20th of Feb.
It's the price is split in two parts: a spodumene price and then a corrective piece later, which is detailed on slide 31.
Okay, cool. I might come back to that. Thanks. And then just in terms of the, you talked to the unallocated portion in time. Can you just give us, in terms of the growth to 1 million tonnes, and bearing in mind that it might be running a bit above that depending on what grade you're producing, how much of that is unallocated? Can you maybe just remind us of the breakdown there, i.e. the 315 that goes to POSCO? How much is left?
Yeah, sure. So, so Levi, once we're fully expanded around the 1 million tonnes per annum, there's approximately 300,000 to 400,000, depending where we take offtake agreements and depending whether we go a bit higher as a function of the product grade. So it's broadly 300 to 400 unallocated.
Okay, thank you. Thanks very much.
All right, thanks, Levi.
Thank you. Your next question comes from David Fan from China International Capital Corporation. Please go ahead.
Oh yeah, good day, Dale, Brand, and the team. So this is David from CICC. Thank you for taking my question. My first question is, in terms of your definition for free cash flow, may I ask why only capex on sustaining capital instead of the total amount of all your capex is included in your free cash flow calculation? And in terms of your free cash flow in the second half of FY2023, given that you just started paying tax from February and the potential high capex compared with the first half, does it make sense for us to expect a lower free cash flow in the second half over the first half of FY2023? I'll come back with the second one.
All right, David, it's Brian here. I might have a go at those couple of questions. So, in relation to the free cash flow and why it only includes sustaining capital, it's all linked to the percentage of cash flow that we're allocating to pay a dividend. So the view is, because we're only paying between 20 to 30%, that means you're holding on to notionally 70 to 80% of the cash flow, and that's all around having cash available to expand the business and look for other both organic and inorganic growth opportunities. So that's what's driving that sort of decision around how we think about the capital and sustaining capital. In terms of the free cash flow in the second half, well, it's very today we sit here. It's really is going to be price dependent. What we can control is I think the level of production and sales. We can hopefully have a red hot crack at controlling our costs. The price, is unknown. So it's very hard for me to sit here today and tell you, I think we're going to have a dividend and that dividend is going to be higher or lower than the first half. But what I can certainly say is that given we're now in the regime where we're paying tax on a monthly basis, the issues around whether we have sufficient franking credits goes away.
Cool, understood. Okay, so just maybe have any color on how should we expect your mid to long-term capex on sustaining capital and waste mine development? Would your expenditure on the sustaining capital grow proportionally with your volume, or it will just largely stay flat in the future?
Yes. So, David, I think sustaining capital as it relates to the mine effectively stable, save for once we've obviously expanded, the absolute number will increase, but from a percentage basis for the processing plant, it will be effectively the same.
Okay, cool. Thank you so much. That's all from me.
Okay. Thanks, David.
Thank you. Your next question comes from Matthew Starrick from Red Door Capital. Please go ahead.
Hi, thank you. I just wanted to ask a quick question about the tolling arrangement. I guess it's probably got two parts, but I guess simplistically, when you say, I'm just trying to work out what aligned actually means. I think last auction you had 8,299 SC6 equivalent. Does that mean you're getting somewhere over at the current lithium hydroxide price, not the future price, which we don't know yet? But does that mean you're getting something over $8,000 a tonne under this arrangement?
I guess that would be the inference, given that it's aligned with it. What we've tried to do here is give a broad guidance without disclosing too much. At the end of the day, this is commercially sensitive, and we need to be respectful to our counterparty in this regard. But I absolutely appreciate that everyone's looking for as much detail as possible. So I'm sorry we can't spell it out and all the detail, but is it a number north of 8 or based on January's pricing? Well, it would be.
Excellent. That helps a lot. And just as a follow-up to that, I guess, does it imply, given it's a tolling arrangement, that the amount of the hydroxide, carbonate or hydroxide, the hydroxide price, you're getting a bigger share of that in price, and the toll treatment is a much thinner margin than, say, the toll treater would take in a normal situation if they were just buying carbonate from you and taking the price risk themselves.
So the way we think about toll treating is the broad idea is you're effectively fixing a processing cost, and then there's a floating pricing point, and then it's a case of how do the proceeds get split. Whether that's the best economic outcomes a function of where you can get to with your other pathways to market. We've got comfortable with this construct, but as I mentioned in the opening, it's a toe in the water. It's a spot sale. It's our first crack, but we think there's merit in continuing to explore this type of model.
No, I'd agree. I think it makes a ton of sense, especially if there's spare capacity out there in the market for sure to process this material. And could I just ask one other question? I've sort of lost a little bit of track with the POSCO joint venture. All things going to plan, and assuming you exercise your 30%, or you're to go from 18% to 30%, your option, you'll have 13,000 tonnes per annum, around about of the 43,000 tonnes in total by around mid-calendar year 2024. I guess, when does that get to full? What's the timeline or the ramp, given we've been seeing probably in the market a few delays around it, but how are POSCO feeling about the ramp up of that production? And I guess, will that be, I mean, you'll take your share of revenue, that's 30% of, if we say hydroxide prices are $75,000 on fast markets today, something like 1.4 billion of Aussie revenue at the current exchange rates. Is that ballpark? And when do you think they'll be at 100%, I guess?
Yeah, no, thanks, Matthew. Look, I think later in subsequent quarters we'll start to provide a bit more insight into what the outlook is for the project. As you can appreciate, right now it's still coming out of the ground. What POSCO has guided us is at least their current plans are quite elongated. They've taken a modest ramp up profile for the operation. So, but I'd add that POSCO is quite conservative, which we like. But it was in the order of sort of an 18-month sort of period to ramp up. Yeah, so but as to the split of the winnings, it's as per that equity split that you mentioned.
Excellent. Thank you. And sorry, just one last question I just thought of. It's a pretty simple one, but it looks like the last 6 quarters you've probably shipped around 50,000 tonnes less than you've produced for the last year and a half. I guess, is there any plans, because it's $300 or $400 million of material, is there any chance that you'll be able to draw down and ship more, or is that right? I'm just taking the sales and what you've been producing.
No, the inventory levels should be that high from memory.
Maybe if I can have a go. There was one shipment that we're hoping to get out in end of December, which didn't quite make it because of port congestion. So that would have been another 20,000 tonnes that would have gone out, which ultimately went out in early January. If you exclude that, then sort of the level of concentrate inventories that we would normally carry, which is in essence about 3 weeks worth of sales, would have been about normal. So there's about 50,000 tonnes of concentrate at the end of December, but 20 of that went sort of within a couple of days of the end of the end of the half year.
Okay. It might have included, my number might not have included the middling sales that you made last quarter and stuff like that. But yeah, sounds good. Thank you very much.
Thank you. Your next question comes from Luke Smith from Australian Super. Please go ahead.
Good afternoon, Dale. I've got just a follow-up question on your first phone call. From the first question, the P680 and P1000, those capacity numbers, are they based on less than 6% SC now?
No, they're based on SC6.
Okay. So just current guidance of 580 is based on 5.7.
Yes.
Okay, thank you.
Yep, thanks, Luke.
Thank you. Your next question comes from Milan Tommy from JP Morgan. Please go ahead.
Yeah, hi. You mentioned revenues from middlings products in the half. Do you have any potential to maintain these sales, and what kind of demand are you seeing for these lower grade products?
Yeah, so as it relates to middlings, as part of the ramp up of the Nugget plant, team streamed a middlings stream, which was effectively through a commissioning sort of phase. We're not doing that anymore as a function of having completed some of the optimizations. The full circuit is taking, it's processing and upgrading everything, which is of course what we want to do, because we want the higher grade sort of SC6 or SC 5.4 etc. product. So we're not looking to produce middlings. But as to those middlings we did produce, what was the market like? Yeah, we had quite a few offers for that product, and we had no issues of moving it. But yeah, as I say, it's not a product we want to do because it's lower value.
Yeah, and just if I can get a second one in as well, with regard to tolling arrangements, it's giving you the benefit of revenue diversification and incremental exposure to hydroxide. Do you think there is appetite for these partnerships in the future? And how are you thinking about weighing up direct investment in downstream versus lower capex tolling products?
Yeah, no, good question, and we think deeply about these different constructs. But one thing we're sure about is that the highest order prize is to be a downstream participant. That's without question. What the thinking is, well, how do you go about that? Is that, where is the location? Do you do it in partnership, etc.? But I think the way we think about tolling is a bridge to that end destination, and it's a pretty good bridge, we think.
Great, thank you.
Thank you. Your next question comes from Mitch Ryan from Jefferies. Please go ahead.
Good afternoon, Dale and team. Thank you very much for this. I've just got one question, and it's with regards to the toll treating agreement, just for a change. One of your peers has reported toll treating costs of between Aussie 8,800 and $7,800 a tonne today. Is that in the realms of what we should be thinking for the conversion and selling costs that would be in your agreement?
That sounds, yeah, we haven't guided on that one, but that sounds really high. That's my honest sort of reaction to that. Yeah.
Okay. Yeah, they were Aussie dollar numbers. So if you put it on US, it's probably 5,500 US. So okay, that sounds high. Okay, thank you. I really appreciate the colour.
Yeah, no worries. Thank you.
Thank you. Your next question comes from Hugo Nicolaci from Goldman Sachs. Please go ahead.
Oh, hi guys. Thanks for taking the follow-up. Again, just on the tolling, I guess more strategically. I mean, now that you've dipped the toe in the water on the tolling mechanism, what do you need to see to, I guess, validate that mechanism to get further into the water and maybe take on some hydroxide marketing? And how do you think that sort of test your capabilities to market maybe future sort of midstream lithium salt products? Thanks.
Yeah. Welcome back, Hugo. What do we need to see? Well, I think the things we're learning here are what's the right commercial construct. There's some complexities around executing these sales. There's VAT, taxes, and there's some tax and legal implications. So there's a category of learnings there. There's also a category of learnings around product quality and the way those responsibilities are handled. And then the third piece is probably a strategic one around whom is that tolling group and where does that relationship go, given that, as I've mentioned earlier, ultimately we're looking to be outright downstream partners. So that's another factor. So those sort of three things we will continue to think through as we explore this avenue.
Great, that's great. Thanks, Dale. And then just one other one. Appreciate on cost performance, you're no longer disclosing your Nungajoo plant costs, but are you able to maybe give us a little bit of a guide on how cost performance at Nungajoo fared this half versus maybe the last half? Thanks.
Yeah, fared okay. Hugo? Probably be the answer there. Vince, did you want to add anything on that?
It's performed well. But so as you can see in our cost guidance, probably can't really disclose too much more, but it's gone well.
Yeah, and we're purposely, the way we think about it, Hugo, is we've got the one mine, we've got multiple processing pathways to deliver different products to market, and yeah, we don't want to really get into subdividing the unit costs within the operation and communicating on that.
Understood. Thanks for that. Cheers, team, and again, congrats on the dividend.
Thanks, Hugo.
Thank you. Your next question comes from Thomas Hayes from CLSA. Please go ahead.
Hi, Dale and team. Thank you for taking the time, and congratulations to Brian. Just got one. Are you able to give us an indication for your average SE6 contract price as it stands today?
Yeah, g'day. Well, we'll leave that for the quarterly. Would be the best way to go. I don't want to give you a bum steer on that, and I don't have those numbers on hand.
Okay, thanks, Dale.
Thank you. Your next questions come from Kate McCutcheon from Citi. Please go ahead.
Hi, Dale. Good morning. Apologies if you covered this. I just jumped on late. Has CapEx guidance lifted on project development and sustaining CapEx? And can I just have some colour on what's driving that? And then the second part to that question is P1000 FID. Can we still expect an announcement this quarter on that?
Yeah, g'day, Kate. I'll do the second part, and I'll throw to Vince to recap on the first part. The P1000 FID is on track for this quarter, so obviously that is subject to board approval, FID, etc. But the team's busy sort of finalising the papers for that. And Vince on the capex.
Yeah, and on the capex and sustaining capex, as I sort of mentioned earlier, we did go through a phase of a very tough market, and we weren't able to spend as much as what we wanted. Conditions have changed, and we are actively going after areas of the business to spend in the areas of improving productivity, recoveries, some of our MPI infrastructure, and also some of our hygiene items, which are linked very closely to our culture, and then continue to improve that. So, and we expect to see improvement in our productivities and performance through a prudent spend in those areas.
Okay, and that's the same for the development, or the project development capex as well. That's in there.
If you're referring to the mine development, that's really around strip ratios, and we want to continue to increase how much we strip, which opens up more ore fronts and gives us greater flexibility and optimise feeds into the processing plants. So, yeah.
Okay. And then my second question, I think Brian may have touched on this, just on the dividend that's franked. So does that mean that you're prepaying tax to be able to declare that fully franked now? How does that work?
No, that's okay. It's not quite how it works. If to be able to declare a fully franked dividend, you need to make sure you've got sufficient franking credits as at 30 June of each financial year. So we've obviously worked out how much tax we'll be paying between now and 30 June. And as long as we've got those franking credits during the financial year, then you can pay the dividend now and actually use those franking credits that get generated when we pay the tax. So yeah, that's we haven't had to prepay tax to actually achieve that outcome.
Okay, perfect. Thank you, Ryan.
Thank you. Your next question comes from Glenn Lawcock from Barrenjoey. Please go ahead.
Morning, Dale. Look, just on this tolling agreement again, if I just read slide 31 correctly, you get the cash from the spodumene sale as it leaves the port. So hypothetically, if the hydroxide price then collapsed to a point such that it's not sufficient to cover, like you've got to pay a fixed price to the toller, and it comes back and you don't have enough, do you then have to reconcile back and give money back from the spodumene sale? Is that what you meant by corrective price? Or do you both share the pain on a collapse in the the hydroxide price?
Yeah, look, I'd have to go back and check that one, Glenn. The construct de-risks Pilbara to secure, the lion's share up front is the way we think about it. And there is a true up to happen. But it's fairly well geared in Pilbara's favour. That's probably as much as I could offer.
Okay. Yeah, fair enough. So you don't expect to get money back at least out of so whatever you lock in for spot, that's your worst case. And then if there's no upside left, that's so be it.
That's the way I think about it.
Yep. Okay. And then just the second one, how do you think we should think about capital intensity of P1000 versus P680?
Yeah, well,
similar capital intensity?
We'll obviously update on that one, Glenn, with the FID announcement when that comes out. But without question, there's been capital escalation and projects across the board, inclusive of our own P680 project. So these expansion projects have gone up in the Western Australian market. There's no doubt about that. So the P1000 project will be more expensive than we contemplated way back in the day. But as I say, we'll be fulsome in outlining that as part of the FID in the coming weeks.
Okay, but that's on a dollar per tonne basis then, because you're adding 100,000 in P680 and you're adding over 300,000 in P1000. So does that sort of mean you should be thinking not almost triple despite, the dollar spend?
I wouldn't recommend necessarily just sort of pro-ratering. The reason being that the capital in each of these investment cases is quite different in that, the P680 primary ejection building, it's a building, screens, pumps and pipes. The P1000's going to be more fulsome. It's a ball mill. It's the whole float circuit. There's some mining infrastructure to go into the larger operation. So it's not an apples for apples kind of scale up. So my advice would be wait for that P1000 FID detail.
All right. Thanks very much, Dale. Appreciate it.
No worries. Thanks, Glenn.
Thank you. Your next question comes from Tim Hoff from Canaccord. Please go ahead.
Hey, congratulations on the outcome, guys, and Brian, for your efforts throughout the journey. We see a few different prices for ex-works hydroxide price out of China that are quite a bit lower than the North Asian price. And so is it fair to say that your tolling partner is aligned to customers that utilise that North Asian pricing?
Well, I think we've kind of referenced that, and for the if this is regards to the spot tolling contract, the answer is yes. We've referenced that, and as you'd expect, we've contemplated all these factors to make sure that we get a really good construct for our shareholders.
And I guess my implication there is that your tolling partners, not some Johnny come lately, that they have got bona fides in the industry.
That's it, Tim. Yeah, no, we don't. We ignore the Johnny come latelys. Yeah.
Excellent. Great work, guys. Thank you very much.
Okay.
Thank you.
So we might move to sort of 10 minutes of the retail questions. 10 minutes? Yep. Yeah, we'll do 10 minutes of retail questions and then we'll wrap up. Over to Nicholas.
Thanks, Dale. We have got a lot of questions, so I'm just going to pick the eyes out of these. And we did cover a number of issues earlier, so I'm just going to go to the relevant ones here. There's a couple of questions around your growth strategy, and the first one here is in terms of deploying cash. Do you see scope to increase the dividend ratio in future? And how do you think about your priorities in terms of deploying available cash with respect to your relevant growth options?
Yeah, sure. So as it relates to a growth strategy, the way we think about it's sort of what we stepped through in the presentation that, highest order priority is make the most of this incredible asset. So expand the operating platform, move downstream, etc. So as that relates to the capital management framework, that's the way we think about it. We want to do that. And as per that capital management framework, we communicated to market. We talked about that 20 to 30% free cash flow measure to be the sort of the guideline for dividends. Is it up for grabs to reconsider that? I think that's possible, but I think that would be quite far down the track, and that would follow probably a strategy re-reviews and the like. So I think, the capital management framework we have would stand for quite some time yet, would be my thoughts.
Thanks, Dale. There's a couple of questions around whether you've considered an offshore or dual listing for the company on an exchange like New York or any other.
It's occasionally the idea has come up. We don't explore too much. That's quite involved to do that listing, and given that we're a single asset operation in Western Australia, it makes good sense to stay ASX listed here. If one day Pilbara was to somehow expand into other jurisdictions, well, that would probably be the time to consider what's the right listed vehicles.
Thanks, Dale. Question about whether you have any plans to considerably increase solar or in the future wind generation on site, and also whether you're looking at next generation trucks such as battery powered trucks up on site.
Yeah, no, absolutely. So we as with all mature organisations, we've got an objective around pursuing a net zero pathway. Within that, I guess the easier things to tackle are displacing some of that base load power, of which our first 6 megawatt solars is the first incremental step. So the way we think about it is yes, we should do more of that, and we've got studies underway to look at that, and I see us investing in that in time. But having sort of pulled the easy, the easy to reach fruit, you then have to work on the harder stuff, which is inclusive of heavy mining equipment, which we will turn our mind to, but in sort of rank order, that's down the list.
Thanks, Dale. Another question here. Is there a strategic point at which you would consider holding additional inventory in the shed rather than BMX and tolling, avoiding potentially short-term dips in the price?
Yeah, I think unlikely we would use inventory to manage tips, and yeah, it's probably worth highlighting that spot sales get a disproportionate amount of attention. The vast majority of our production profile is through long dated offtakes, and in the main there is a smoothing of pricing contemplated in that. And I'd also note that further downstream, particularly outside of China, my understanding of most of those contract relationships are generally longer dated, more smoothing of pricing through the supply chain, which helps counter that volatility. So to an extent, we do have some defence against that volatility, but as I say, I don't think we would invest in large stockpiles as a method by which to either sidestep down dips or capitalise on upticks.
Thanks, Dale. And just one final one. Would you consider diversification into other battery metals or minerals outside of lithium?
I think it's not off the cards. The inorganic growth plank is as I sort of outlined earlier in the presentation is number 4 down the list. We're very much early in the thinking of what does inorganic growth mean for Pilbara Minerals, and yeah, so very much early in the thinking. Chief Development Officer John Stanning, who started, will start to unpack and progress some of the thinking for us in this regard. But meanwhile, we'll keep focused on our core business of delivering more lithium units to market.
Thanks, Dale. I think we've covered the key issues there, so I'll hand back to you to close.
Thanks, Nicholas, and thanks everyone for dialing in. An absolute stellar half-year results. Fantastic to announce the inaugural 11 cents dividend. A big thank you to those long holder shareholders of Pilbara Minerals who've gone the full journey. We know, we appreciate the notes over the years, and I hope that this is a bit of vindication for your faith in the company and the team. So thank you, and a big thank you just to all of the different parties I touched on who have been part of the success to date. The customers, our contracting partners, the Nyamal community, and the team that we have, the team who progressed us to this point, and the team who's carrying the baton forward. A big vote of thanks, and look forward to a fantastic future for the company. We are just getting started, and looking forward to updating on the big growth leaps in the quarters to come. Thank you all, and look forward to talking again in the future. Thank you.